you can't have a bull market in emerging markets with a strong dollar. They're basically 1-for-1 correlated. So emerging markets, usually at this point in the cycle, should also start to perform again. So if we think of the GMI macro allocation model that I think we presented in this room a few...
Yeah, we were just talking about that, the business side,
Yeah, that model will spit out, it should be a weaker dollar environment. It's not currently, which is a bit of a surprise. It should be an EM pickup story, should be a commodity story, should be a technology story. That's normally what happens at this point. Bonds are usually a bit iffy because you've still got the remnants of inflation until you go to sort of the macro summer phase, where you're then getting into the disinflationary trend plus growth, which is the phase I think we hit in 2024. So the hard asset story, we don't know if it's a secular story or not. We know the supply constraints. We just have to see how that plays out, and it's not absolute price that matters. So oil at $100 is not necessarily wildly inflationary, because don't forget, it was at $100 a year and a half ago. So you need to think about rate of change terms, which confuses everybody as well. So always, early cycle, you'll always see this pickup. And it's that weird dichotomy where the heavy inflation's slowing down and the forward-looking stuff's going up that often creates this little uptick in inflation for a few months. So we produced a chart in GMI which shows all of the inflationary episodes since 1940 and just put this against it. This is absolutely spot on normal. That it's normal, and every time we get this little pickup, because it's that little point where the commodity markets breathe a sigh of relief, they start rallying, but then the really heavy kind of disinflation stuff happens and inflation rolls over. So I still think inflation rolls over. I'm still not a big bar of inflation. Commodity inflation's about 18% of CPI. 68%, 70% is like rents. So all the big stuff is still to come.
The US is close to approving Bitcoin ETF, which could transform the market by broadening its investor base. Canada's Purpose Bitcoin ETF attracted significant inflows. The US, with a larger market, might see even more. When Bitcoin sees substantial investment inflows, historical data suggests it performs well, potentially leading to a significant rally. A projection suggests a 66% BTC rally to $42,000 with US BTC ETFs, though it doesn't consider all market factors. Paper Bitcoin, Bitcoin futures, trading volumes are overshadowing actual BTC transactions, impacting the market and ETF delays. Bitcoin's decentralized nature clashes with centralized gold control, causing ripples in the crypto community. Futures markets dominance delays spot ETFs, reshaping Bitcoin's landscape. Analyst Benjamin Cowan predicts a potential $23,000 Bitcoin dip due to historical patterns and market challenges. Altcoins may face difficulties in the coming months, a common crypto trend. Historical data suggests Bitcoin might drop before its next halving event in April 2024. Despite challenges, some bullish predictions anticipate significant Bitcoin growth. Let's continue our discussion with Raoul Pal.
Have inflation, the slow component slowing down, but they've just started. The forward-looking stuff, the commodity stuff starts picking up, and you're bottoming in the business cycle. We saw the ISM coming out today, and it looks like it's at a bottom, and that's the work that Julian and I have done at Global Macro Investor. So we actually think the economic cycle picks up, but the stuff like inflation, the wages, the rents and stuff slows down. So this point is classically a good point for commodities. Because they get bombed out in the bad side of the cycle, and then you start to get the relief rally. So it's classically good for that, but it's also classically good for technology, which is why technology has been the best performing sector the whole year. So that's why people are so confused, because they kind of want it to be one or the other, and it's not. My point was, last year, this was all priced in.
Right.
So what a lot of people find funny is like, I say, well, the equity market priced in the economic slowdown last year, and a lot of people say that's ridiculous. But those same people are actually the commodity bulls, where the commodities priced it in last year as well. That's when most of the commodities fell and did most of their damage on the downside. So we had all of that last year. So this is it's always a confusing point in the market. And I don't know a single business who's not seen a slowdown. I don't know a single person who's not had to let go of staff. I've not seen any sign that we've got robust strength. So yes, you might get the government sector growing somewhat from the fiscal stimulus, But what you're seeing is the private sector is struggling. And we've seen that pretty much everywhere. So if that's the case, then usually if ISM's bottomed, therefore it bottomed over the last few months, that leads GDP by a quarter. So we probably end up seeing weaker GDP numbers. We might get downward revisions soon, and then we'll get weaker GDP, I think, into Q4 and Q1, because it takes a while before it comes back up from the bottom again. And my hypothesis always was this was going to be a mild recession. It's like 1990. It's a mild recession. The markets fall kind of between 25 and 40%. Sure, some stuff like technology, the growthy end of technology went down to 75%. Some of the commodities got hit equally as hard. But overall, it's a relatively mild event, which is hard to believe with rates having gone up as much as they have. Yeah, and I've always said you can't have a financial crisis again.
Yeah.
And the reason being,
why?
Because you've got the magic money printer. And what that does is debase the currency. So why 2008 was so bad is the value of collateral. So in a debt-driven world, you have to pay your interest rates and your collateral must maintain. If the collateral collapses, then you've got this huge gap and everything blows up. So the magic money printer essentially optically makes the value of the collateral rise, so you don't default. So that's what happens here. So we're seeing it with what the Fed have been doing by taking off some of the, giving the emergency lending to some of the smaller banks. That's essentially the same thing. They're supporting the collateral by taking essentially the bonds, which they're underwater on, and making them whole on it. Everybody should just watch that chart of KRE, just ticks down every day in the BKX. The banking system doesn't like an inverted yield curve. It certainly doesn't like it when they're offering 0.5% on deposit rates and money market funds are offering 5.5% or whatever they're offering. So that whole process is still underway. The Fed is still essentially emergency lending more and more each week. So it's just a quiet, slow death going on. And just watch that price, because if it breaks back down below the price of whatever was March or April or whatever this year, then everyone starts to panic again. And I think we're in that phase. September, October, great month for a good panic.
Traditionally terrible.
And usually that is normally the bottom of the bear market. The bottom of the bear market, the actual bear market, was October. And I remember talking about it in Daily Briefing and also on Twitter and writing about GMI. It's the bear killer month. So normally this kind of volatility happens very normal this time of year. We should expect more volatility into October, but usually that's when it stops. If you think about it, tech had its horror story beginning of the year, commercial real estate, the banks, and it's just, you're right. It's kind of rolled through bit by bit. So we'll wait and see. But all I do know is American employment is really based around small and medium-sized enterprises. That's the American economy. And these people can't, these kind of rates take time to work through, but it just makes it harder for them to run businesses, harder for them to pay their rents, harder for them for a number of things. And slowly over time, you'll see that has an effect on the economy. So it's not a big whoosh.
A recent buzz within crypto circles revolves around the 1996 research paper from the US National Security Agency, NSA. There's burgeoning speculation. Did the NSA lay the groundwork for Bitcoin? Indeed, there are striking similarities between the NSA document and the Bitcoin white paper. However, a detailed look suggests a tighter connection to centralized Chaumian models described years prior. Coinbase revealed a campaign to move more than 52 million US-based cryptocurrency holders to call for clear and precise regulation. The push, part of a countrywide initiative, will be supported by a paid media campaign across multiple platforms, but directed to 9 states where most crypto owners are concentrated. According to Peak Mining, the subsidiary of Northern Data Group, the company has signed a contract with Bitcoin mining rig manufacturer Microp worth $150 million. This agreement will equip Peak Mining with 7 exahash per second, E/S of the latest next-generation BTC mining devices. If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.